You wouldn't think a boring bank crisis happening 6,000 miles away in Tokyo has anything to do with your crypto portfolio, right? But what if I told you that a disaster unfolding in Japan right now could be the exact trigger that forces the US Federal Reserve to turn the money printer back on? It sounds like a conspiracy theory, but it's just cold, hard macroeconomics. Arthur Hayes, the co-founder of BitMEX and a legend in predicting these macro shifts, just dropped a bombshell analysis. He believes the Fed is about to get their hand forced. They're going to have to print dollars to save the Japanese bond market, and in the process, they might just accidentally ignite the next massive Bitcoin bull run. So how does a Japanese bank dumping bonds lead to green candles for BTC? And more importantly, is money printer go Burr finally making a comeback? Let's dive in. To understand this, we have to talk about the elephant in the room, or rather the whale in the ocean, Norinchukin Bank. Think of Norinchukin as the agricultural bank of Japan, but on steroids. They manage a massive amount of Japanese deposits. Years ago, when interest rates in the US were practically zero, Norinchukin got hungry for yield. They took all that yen, swapped it for dollars, and bought a mountain of US and European sovereign bonds. It seemed like a safe bet at the time. But then, the Fed started hiking interest rates aggressively to fight inflation. Here's the simple version of the trap they fell into. When interest rates go up, the value of old, low-interest bonds goes down. It's simple math. Imagine you're holding a bond that pays 1% interest, but new bonds today pay 5%. Nobody wants to buy your old bond unless you sell it at a massive discount. That is exactly where Norinchukin is sitting right now. They are sitting on huge, unrealized losses. To stop the bleeding, they've announced they need to sell off about $63 billion worth of these bonds. Now, here's the scary part for the US economy. If a whale like Norinchukin starts panic selling $63 billion in US Treasuries, it floods the market. When supply goes up, prices tank, and yields, the interest rate the US government has to pay, skyrocket. That is a nightmare scenario for Janet Yellen and the US Treasury. So why does Arthur Hayes think this is bullish for Bitcoin? Because the US cannot afford to let the Treasury market collapse. Hayes argues that the Fed isn't just going to sit back and watch Japan dump US debt. They're going to intervene. Hayes points to a mechanism called dollar liquidity swap lines. Essentially, this is the Fed printing fresh dollars and handing them to the Bank of Japan, so the Japanese banks can borrow dollars instead of having to sell their treasuries. If this sounds familiar, it's because we saw a version of this movie before. Remember March 2023, the Silicon Valley Bank collapse. When the banking sector started shaking, the Fed stepped in with the Bank Term Funding Program. They essentially printed money to backstop the bank's losses. And what happened to Bitcoin in March 2023? It ripped. It rallied hard. Hayes uses a great analogy here. Think of the economy like a bathtub. The water is the dollar liquidity. Bitcoin is a rubber duck floating on top. When the Fed has to save the system, whether it's SVB in California or Norinchukin in Tokyo, they turn on the faucet, they add more water, and when the water level rises, the rubber duck, Bitcoin, rises with it. The specific details of the crisis don't matter. What matters is the solution, and the solution is almost always inject more liquidity. So what is the play here for us? What do we do with this information? Arthur Hayes' advice is pretty straightforward. Buy the dip. He believes the macro trend is shifting back toward easing and liquidity injections. The current chop and volatility we're seeing in the market, that's just noise. The signal is that the central banks are trapped. They have to print to keep the sovereign debt bubble from popping. However, this isn't financial advice to go all in with 100x leverage today. The market can remain irrational longer than you can remain solvent. But the strategy is to look past the fear. If you see headlines about Japanese banks struggling, don't panic. Recognize it as a signal that more dollars are likely entering the system soon. Hayes suggests rotating out of fiat currency, which is being debased to save these banks, and into hard assets like Bitcoin that have a fixed supply. Ultimately, the Norinchukin saga is just another reminder that in a debt-based system, the money printer is the only tool they have left, and historically, Bitcoin loves the sound of that printer. But I want to hear from you guys. Do you think the Fed is going to bail out the Japanese bond market quietly, or are we going to see a market crash before they step in? Let me know your thoughts in the comments below. And if you want to stay ahead of these macro shifts, make sure to smash that like button and subscribe to the channel. We're tracking the money flow so you don't have to. Thanks for watching, keep your eyes on the liquidity, and I'll see you in the next one.